Here is the part of a mortgage that feels almost fake. You make the first payment. It is real money leaving your account. But almost none of it buys the house. On a $400,000 30-year mortgage at the current average rate, the first monthly payment is about $2,492. Out of that, roughly $2,120 is interest. Only about $372 actually cuts the loan. That is why mortgages can feel like a trap. The payment says homeowner. The math says renter of money. And the strange part is that this is not usually a hidden fee, a special penalty, or some fine print trick. It is the normal design of a standard amortized mortgage. The monthly payment stays steady, but the split inside that payment changes slowly over time. The rule is simple. Every month, interest is charged on the balance you still owe. At the beginning, that balance is enormous. If you borrow $400,000 at 6.36%, the first month interest is calculated on almost the whole $400,000. That alone is about $2,120. The payment is only about $2,492. So interest eats almost the entire payment before principal gets a turn. This is the part people often miss. You are not paying interest on the original house price forever. You are paying interest on the remaining debt. As principal slowly falls, the next interest charge gets a little smaller. That leaves a little more room for principal. Then the next month, the balance is smaller again. In theory, it is elegant. In real life, it feels brutally slow. After 5 years, the effect is obvious. 60 payments of about $2,492 means you have sent the lender almost $150,000. But on this example loan, only about $26,000 has actually reduced the debt. More than $123,000 went to interest. You have been paying faithfully for half a decade, and the mortgage balance is still around $374,000. That is not because the lender forgot to credit your payments. It is because a 30-year mortgage is not only a price, it is a clock. A shorter clock is harsher month to month, but it moves principal faster. A longer clock is easier to survive every month, but it gives interest more time to work. The 30-year mortgage makes expensive homes feel monthly affordable. The trade-off is that the first years are mostly a payment for time. Rates make that clock heavier. On the same $400,000 loan, a 3% rate has a monthly payment around $1,686 and total interest around $207,000 over 30 years. At 6.36%, the payment is about $2,492, and total interest is almost $497,000. At 8%, the payment rises near $2,935, and total interest becomes roughly $657,000. Same loan amount, same 30 years. A different rate changes the shape of your life. This is why the phrase, "I bought a house," can be misleading. At closing, you get keys. Legally, you own the home. Economically, you also bought a stream of future payments. The bank does not own the whole house in the simple everyday sense, but it does hold a claim secured by the house. If you stop paying, the contract matters. The key is yours. The clock is theirs. The curve does eventually flip. On the same example mortgage, the principal part of the payment does not become larger than the interest part until around month 230, a little over 19 years in. That means the early mortgage is a slow climb. Year 5, about $26,000 of principal paid. Year 10, about $62,000. Year 15, about $111,000. Then, late in the loan, principal finally starts falling fast. That is also why moving or refinancing can feel like starting over. If you sell after a few years, you may have paid a lot of interest without building as much equity as you expected. If you refinance into a new 30-year mortgage, the payment might drop, and that can make sense in some situations. But the amortization clock can reset. The monthly payment feels softer, while the timeline stretches again. There is one lever that changes the math: paying down principal sooner. On this example, an extra $200 a month would shorten the loan by roughly 5.5 years and reduce lifetime interest by about $108,000. But that is not automatic advice. Extra payments compete with emergency savings, higher interest debt, retirement contributions, and the need to stay liquid. The point is not that everyone should prepay. The point is that principal is the part that fights the clock. So, no, a mortgage is not always a scam. For many households, it is the only bridge between renting forever and owning a home. But it is a bridge with a toll booth on every month of the journey. The dangerous mistake is thinking the payment tells the whole story. It does not. The real question is not only, can I afford the payment? It is, how much of this payment is buying the house and how much is buying time?